we have the presentation by Pei-Ern. Did I pronounce properly? I practice a lot.
Yeah, about that.
Great. Who is an associate economist at the Research and Modeling Unit at Bank Negara, Malaysia. Her primary role is to conduct research and develop quantitative models regarding monetary policy and stability. And today she will be presenting her work on the ratio between output and inflation in Malaysia. So this is gonna be a short seminar. It's gonna be about 30 minutes presentation with 10, 15 minutes for questions. So we should end up by 10:45. But as usual, if there are questions online, please feel free just to jump in or to write down your questions in the chat. So the floor is yours, and thank you very much.
All right, thank you, Augustine. And good morning, and thank you everyone for joining the seminar. So we'll start the presentation on sacrifice ratio between output and inflation for Malaysia. So since the beginning of last year, we have seen inflation rising to elevated levels, the levels that we have not seen in decades. And especially for Malaysia's case, we did observe inflation to be reaching an all-time high at around 4.2% in November last year, which was more than double our long-term average for core inflation. And we were not the only ones who were experiencing this. In fact, on the global front, the United States, United Kingdom, and also the Euro areas had also experienced this unusually high inflation environment. The cost of living crisis did cause price stability to be a main concern for central bankers all over the world. So what really motivated us to pursue research in sacrifice ratio really is to attempt to quantify the potential output losses that are required to be incurred in order to reduce inflation. So there were a few key events that led to this research. One of the major ones was the aggressive global monetary policy tightening. And how this tightening happened, really, this was actually initiated by central bankers who are taking monetary policy actions in response to a high inflation environment, which was experienced by most countries. So especially for the US case, the Fed was actually one of the first central bankers who had raised interest rates, and this was subsequently followed by other central banks all over the world. So this leads to our second key event, which was the Russian-Ukraine conflict. So this conflict had triggered a major supply chain disruptions, and this supply shortage has resulted in significant increase in prices. And on top of that, at the same time, we were also observing a recovery in the labor market conditions, which had led to an improvement in our domestic demand. So these confluence of factors had motivated us to conduct research to estimate the sacrifice ratio for Malaysia. And the aim of our study really is to assess the trade-off between growth and inflation, and to also estimate how much output losses that we need to incur in order to bring down inflation from its high levels. And secondly, we would also like to explore what are the drivers that are determining the size of sacrifice ratios, and to see if there are any methods that we could minimize output losses to lower inflation. And lastly, we would also like to see how these findings would affect our policy actions. So what exactly is sacrifice ratio? We did find a couple of definitions in past literature, but generally, sacrifice ratio is conventionally defined as the cumulative loss in output resulting from 1 percentage point of reduction in inflation. So in other words, sacrifice ratio estimates the trade-off between output and inflation. So Lawrence Ball, back in 1994, had observed that the act of reducing inflation is always correlated with some short-term output losses that are quite substantial. And what Lawrence Ball intended to do in his research was to develop a systematic approach to estimating sacrifice ratios for specific episodes. So in this case, sacrifice ratio stands as a statistical measure of how much output losses that we need to sacrifice in order to bring down inflation. So besides that, there is an alternative definition of sacrifice ratio, which is also known as the cost of disinflation by Cheah and Rich. And Amaduchi, in this research, also pointed out that sacrifice ratio is an extension of the Phillips curve, which points towards an inverse relationship between inflation and unemployment in the absence of supply shocks. And this unemployment that we had mentioned here is related to some output losses, since high unemployment implies low output and vice versa. So sacrifice ratio is actually a pretty old topic, and this was actually frequently referenced in the United States back in the 70s and 80s during vocal disinflation and the subsequent Great Moderation period. So during that time, disinflation was actually a major cause of recessions. And at the economic downturns, these economic downturns had coincided with falling inflation, which was caused by a monetary policy tightening. So we'll start on our methodology in how we estimated sacrifice ratios. We did find a variety of techniques in past literatures that was used to estimate sacrifice ratios. So in our research, we have decided to choose two methodologies to provide a more comprehensive and richer analysis to estimate sacrifice ratio. And these are the econometrics and also the non-econometrics approach. So we'll first look at the econometrics methodology, which comprises of two approaches. And the first is the Phillips curve approach, and second is the simulation approach. So the Phillips curve framework used to be one of the most common approach to estimate sacrifice ratio. And this framework was actually first coined by Okun in 1978 and subsequently refined by Gordon and King in 1982. And in this approach, sacrifice ratio is being derived from an estimated Phillips curve model, which looks at the relationship between output and inflation over a long time series. So the estimated parameters that are being used to derive sacrifice ratio is actually the degree of inflation persistence and the parameter that measures the response of inflation to output gap. And how we have estimated these parameters is by using our internal New Keynesian Phillips curve model. So moving on to the second approach, which is the simulation approach, how we're doing the estimation is we are computing a simulation, which is done by simulating a disinflation conducted via a monetary policy hike. And the monetary policy reaction function that we use here follows the conventional Taylor rule setting framework. So similarly to our previous definition, sacrifice ratio in this approach is derived by dividing the change in annualized cumulative output losses by the changes in inflation, which both of these are estimated from the simulation in our model. And we have calculated this using our internal DSG model. However, there actually is a limitation of this econometrics approach, and that is that the method constrains the sacrifice ratio to be the same for all disinflations within a time series. But actually, this might not be the case if sacrifice ratio is being influenced by other factors which are specific for certain disinflation episodes. So this could either be initial conditions of the disinflation period or the credibility of a central bank, which might induce shifts in inflation expectation. So each disinflation periods actually do have specific sacrifice ratio estimates. Which brings us to the next methodology.
Sorry, but just, if you go back a slide.
Yep.
In any, if the key output we are interested in somehow is the sacrifice ratio, unless you tell me what goes into this machinery, into your internal DSG model or this, it's very hard to say, or you're going to tell me how I should think about the numbers that you get from the model, how they match up to some benchmark, how I should think about them, or you're going to tell me what are the assumptions of your internal DSG model to be able to kind of think about them, or?
Right. So our internal ESG model is actually calibrated for our Malaysian economy, and it's actually being, and how we're doing it is we're simulating a monetary policy hike using that DSG model, and we wanted to see what's the impact on GDP and inflation following the hike. So using the changes from the impact on GDP and inflation, that's how we calculate the sacrifice ratio, which is specifically for Malaysia's case. As for comparison benchmark, that's why we're actually using both methodologies. So first is the Lawrence-Wall's approach, which we will explain more in the next slide. And then we're comparing this with the econometrics approach, which we also have two approaches, so that we can get like a range of estimates to see whether our results are actually consistent overall. Yeah. So if there's no questions for now, I'll move on to the second methodology, which is the historical approach following Lawrence-Wall's methodology in 1994. So this approach actually addresses the previous limitation that we had mentioned from the econometrics approach. So this is actually a time-varying measure that calculates the trade-off between output and inflation for specific episodes of disinflation. And similarly to our previous definition, sacrifice ratio is calculated by dividing the sum of output losses by the change in inflation. But the key difference here is this only covers for the specific disinflation period. And the sum of output losses, following Lawrence-Wall's definition, is actually the difference between actual output and its full employment level, which is also known as the trend level. So the trend output level, which was defined by Lawrence-Wall, is actually computed by interpolating between 2 points where actual output is actually equal to its trend output. And this trend is being formed on the basis of 3 assumptions, which was assumed by Lawrence-Wall. So the first assumption is that output is at this trend level at the start of the disinflation period. And the second assumption is that output is again at this trend level 4 quarters after the end of the disinflation episode, which is also where inflation is assumed to be stable again. And the final assumption that we make, that Lawrence-Wall made here, is that trend output grows log linearly between the 2 points when actual output and the trend output are equal. So that's how the output trend is being computed. As for the estimation steps, we have 3 steps in total. So the first estimation step is to identify what are the disinflation periods based on our historical data. And we'll actually explain more of this in the next slide. In the second step, based on the assumptions that we have on trend output, we will then derive the sum of output losses over the specified disinflation period. And lastly, we calculate the sacrifice ratio following the formula that we had stated on the left-hand side. So in our study, on top of the output losses that we had derived from the trend level, we also use various measures of output gap as an alternative estimation of output losses to derive sacrifice ratio. So the reason for this really is to minimize the measurement errors and to provide a range of the estimation of our sacrifice ratio. Okay, so in this slide, we'll talk about how we identify disinflation periods. So in our study, our definition of disinflation episodes is actually any period in which inflation falls below 0.5% with a negative output gap that lasts for at least 8 quarters consecutively. And the reason for this is actually to ensure that each disinflation episode is not ended by a brief increase in inflation in the midst of a longer term decrease in our output. So as you can see on the left-hand side, the graph shows the historical core inflation with 0.5% being set as the horizontal axis. And the graph also shows the average of all output gap measures, which is being estimated by our internal models. So for Malaysia's case, we have identified 3 disinflation periods following our definition above, and these are being represented by the 3 shaded areas in gray. So the first disinflation period occurs around end 1998 to early 2003, which was the period after the Asian financial crisis. And the second period that we did observe is from March 2009 to December 2010, which also happened after the global financial crisis. And the third, which is also the most recent period, started from end 2019 to end 2021. So moving on to the findings from our research from Malaysia, using the 2 approaches, what we did find is that the annual sacrifice ratio for Malaysia is around 2.5, which means that the cost of output to lower inflation by 1 percentage point is about 2.5 percentage points. And the average of mean lag, which measures the speed of pass-through from output gap to core inflation, is around 3 years. So what this suggests is that we have a relatively slow pass-through effect to core inflation. We also found that a large sacrifice ratio usually corresponds to high nominal rigidities and a flat Phillips curve. So for instance, if inflation is less sensitive to output gap and the slope of the Phillips curve has also become flatter, so this implies a larger sacrifice ratio, indicating a larger output losses that central bank must tolerate to taper inflation. So looking at the bar charts on the left-hand side, at the bottom part, so the bar charts here represent the sacrifice ratio that we had estimated across 3 different disinflation periods for Malaysia. So as you can see, the bar chart in the middle actually represents that sacrifice ratio was the largest back in the 2009 period. And this was actually caused by the elevated inflation expectations during a cost-push inflation period. And a policy implication of our findings is really that OPR heights, our interest rate height, is the most cost efficient in a benign expectations environment, which is being supported by a high policy credibility. And these use the lowest output loss that is required to reduce inflation, as the credibility of central bank will help minimize sacrifice ratio.
This is your third point is an empirical observation, or is your interpretation of the data?
This is actually interpretation of the data for that specific period on the third point. So we'll look back at what was happening during that time period and see what's causing the largest sacrifice ratio during that time.
And it's not possible to empirically test your set of explanations that you might hypothesize, is because the differences are not at all in the literature, but the differences seem quite sharp across the different periods, right?
Yeah, that's true. And it's not possible for the empirical part because based on our econometrics approach, they actually assume that sacrifice ratio is the same across all periods. So we can't look at specific periods and just to justify what are the reasons for that using the econometrics approach. That's why. So this is actually just based on Wall's approach for the specific sacrifice ratio for specific episodes. Yeah.
Can I make a question? I'm a little bit confused because especially you are looking to crisis periods, right?
Yeah.
That basically, I mean, in all these periods, like basically is crisis that we observe in Malaysia, but driven by exogenous shocks, right?
Yeah.
I see global crisis, this oil price shock, I don't know.
Yeah, it's about that.
And I guess COVID. So in those cases, I mean, specifically in this case, for example, like inflation is high and GDP has decreased as a consequence of the same shock, right? And I think it's the same case for the 3 periods too.
Yeah.
How in your econometric strategy, how do you like disentangle like this trade-off between, okay, I'm gonna reduce inflation, that's gonna have an output loss, but how do you distinguish the effect of the policy from everything else? Like I don't see that in the
that difference, right? So if we were to use the boss approach, it would be hard to disentangle the effects that we're doing from monetary policy hike and also the supply factors that we might be experiencing during that time period. That's why we had tried to explore the econometrics methodology, which actually strips out the supply side factors by looking just at the demand factors. For example, in our Phillips curve model and also the international DSG model, the simulation approach, that's where we try to strip out supply factors and just focus on the demand factors to determine the size of sacrifice ratio, because sacrifice ratio should only focus on the demand side factors. However, we do note that if we were just to look at our core inflation data and just to take the changes in our output gap and also changes in inflation based on Boss approach, that's where we cannot strip out the supply side factors. That's why we are trying to balance it out from two approaches to look at an overall estimate for the concept for sacrifice ratio.
Okay,
Yeah.
and I mean, this is more like philosophical question, but what is worse, inflation or reduction of growth? Like, I mean, like the problem with this kind of models is that we don't have really a measure of like social welfare, right? We cannot assess that. We cannot see what are the welfare gains of a specific policy. But here, what is the benchmark? What is the policy recommendation? What is the adequate rating?
So we don't have an answer to which one is better, like whether inflation is high or by sacrificing output. But what we can give advice is, so for policymakers, what we know from our research is that in order to reduce inflation by 1 percentage point, you would have to tolerate a loss of output by around 2.5%. And whether, so this is for your consideration and whether you can tolerate the output losses that we have estimated. Of course, this is just an estimation and not the actual output loss. But if you think that the environment at that time, it is more, I would say, urgent to bring down inflation, and that the losses that you have to sacrifice is, you think that it's something that you could tolerate at that time, maybe in a good economy environment, then I think that policy makers would just go with it by just reducing inflation and moving on, like what we're happening right now. But for example, if you think that the economy is too volatile, that really depends on the decisions of the policymakers, whether you are willing to take a step to sacrifice the output in order to bring down inflation. So it really depends on the decisions of the policymaker. So what we can do is just to give a general idea of how much output losses that you would have to sacrifice in order to bring down inflation.
I mean, because 2.5 sounds like a lot, no?
It does seems quite substantial.
Okay.
Yeah. Yeah. So if there's no other questions, I'll move on to the next.
And the neighbors would look comparable in terms of the sacrifice ratios for in Malaysia?
Okay. We did try to find sacrifice ratios for regional countries, but there wasn't much literature about that when we were doing this exercise. Even if we did find for some literatures about from the US and also UK, for example, they actually look more towards the older periods in the 1970s and 80s and not much in the recent periods. It's possible because inflation targeting framework was something that they had adopted, so inflation had been relatively stable over time. So that's why there wasn't much to show on this. So there might be more recently maybe, but we haven't actually explored that. As for whether it's comparable or not, generally, we can't say that it's actually directly comparable, because even in the past literature, it is widely known that sacrifice ratio does differ a lot, even for different countries or different methodologies, because it depends on, for example, your choice of sample size, and it also depends heavily on your output gap estimations. And these are actually latent variables that we cannot observe. So therefore, it is widely known in past literature that sacrifice ratio does change a lot. And you can see like huge variations across different periods and also across countries.
Yeah, I mean, across countries, I mean, depending upon, you might assume there are certain fundamental or institutional characteristics that drive these differences, and that's at least palatable, you know. But if different methodologies are going to give you widely different results, then there's something that we should be, then how do we come up with what should I trust, you know?
Yeah, definitely. That's why in our research, we just try to use like more methodologies to provide like a more credible and valid results of sacrifice ratio. but we can't say for sure that this is the exact estimate of sacrifice ratio that we're estimating. We can only say, try to pinning down like a specific number for sacrifice ratio is actually quite challenging and not very possible. So we just try to find like an average of our estimates for sacrifice ratio.
So what's the confidence intervals that you get on your, what should they, if I was the policy maker, what would you tell me? What's my most nightmare scenario and what's my most palatable scenario if I was going to cut inflation in Malaysia?
I would say that the baseline is 2.5. As for the worst case scenario, I can't say for sure because sacrifice ratio also depends on your conditions at that time. Whether your inflation levels are at a high level initially, or whether it's still at an anchored level, or if it's actually in an unanchored level, then your sacrifice ratio would actually multiple, like double or like triple, like it could be a non-linear sacrifice ratio that we cannot estimate. So this is really just a finding that we did for when inflation is still in a stable and also a benign expectation environment. So if it goes haywire, for example, inflation is unanchored and the central bank is not credible at all, because the public might think that, central bankers are not taking enough monetary policy action to taper inflation, then the sacrifice ratio would definitely be much, much larger. And that's something that we could not estimate because it really depends on inflation expectations and inflation environment and a lot of other factors. And the credibility of the bank also would be a huge matter in this case. Yeah. So if there's no questions, I'll move on to the next slide.
I mean, there are questions, but there is no time, right?
Yes.
Yeah. So looking at the results that we had gotten from the econometrics approach, so overall, we find that the estimations from the simulation and Phillips curve approach are broadly in line with our findings. And the annualized sacrifice ratios range from 2.18 to 2.5. And based on our internal DSG model, we did observe that the peak impact of a monetary policy hike on annual inflation happens around the fourth quarter. And as for GDP, as you can see on the right-hand side, the orange line, GDP growth recovers around the fourth quarter and peaks at the sixth quarter following an OPR hike. So as I mentioned before, these model-based estimates do not take into account the supply side factors as compared to the conventional BOS approach, which is contingent on the core inflation data, which might have already incorporated the supply side factors or other factors at that time. So moving on to the results that we had estimated from BOS approach, basically we saw an overall upward trend in sacrifice ratio across the disinflation periods. And this finding is actually consistent with past literatures, which also observe an increasing trend in the episode-specific estimates. So this is actually quite true for these episode-specific estimates, as they reflect a narrower defined period in contrast with the model estimates, which are estimated for a longer horizon. And besides that, we also found that the sacrifice ratio estimates depend heavily on the choice of output losses, which are calculated from the output trend or the measures of output gap. Though, as you can see from the table, there's just one point that we would like to make here, is that the estimates from BOS output trend is not directly comparable with the estimates that we had derived from the various measures of output gap. And this is actually because the concept of output trend that is being deployed in BOS approach is different from the traditional output gap concept, which is assessed from the potential output of the economy. That's why it's not directly comparable, as you can see from the results. So in this slide, we have listed down a few factors which are driving the size of sacrifice ratio. So firstly, as we had mentioned before, the sensitivity of inflation to output gap will affect the size of sacrifice ratio. And we find that the sacrifice ratio is much higher when inflation is less sensitive to output gap.
But that's tautological, right?
Yeah. Definitely. Yeah. Yep.
It's like saying if the numerator increases, the ratio will increase, you
Yeah,
know?
based on the formula.
Yeah.
But what this could actually indicate really is a flat Phillips curve, or rather a high nominal rigidities environment. So when we have like a high nominal rigidity environment, this indicates that there will be slower price adjustments. And this will lead to lower sensitivity of inflation to output gap, which is correlated with the slope of the Phillips curve. Therefore,
And can I ask you what leads to higher what factors that underlies the situation which might, like, why would be, of course, the Phillips curve being flat, like you say,
yeah.
would result in what you say true in the first point. But the question is under what situation should we expect the Phillips curve to be flat, right?
Yeah.
Or for nominal rigidities to play a more important part, because I agree with both of them,
yeah.
but that's definitional, right? That doesn't tell us why that should happen.
Yeah. So I suppose like the high nominal rigidities would either happen either as part of the structural economy, like the behavior of the agents that you have, and these could also change due to like different key events, for example, that would sort of like change the behavior of your agents. Credibility of the central bank ones could also change these parameters, like the nominal rigidities of your agent. As for the Phillips curve, I think that also depends on the inflation expectations and also the inflation environment of the economy. And for one, I think a few years back, we did observe like a few research that was saying that Phillips curve was becoming flatter and everything. But there was also some findings that say that that's not really the case. So it really depends on whether there's an evolution in the Phillips curve observation, which I think we are also doing some research on in our bank at the moment. Yeah. So if you move on to the second factor, it's actually the credibility of a central bank, which is a really important factor that will affect inflation persistency. So if a central bank is actually credible, for instance, the impact of nominal rigidities can be mitigated because people will have in their expectations, in their mind, that the central bankers will be taking action in reaction to a high inflation environment. And therefore, the persistence of inflation can be lowered, and therefore also reducing the size of sacrifice ratio. So that is actually based on the basis that credibility of a central bank affects the inflation expectations and also the forward-looking view that people hold of the economy from the central bank's actions. And moreover, the initial inflation conditions does matter when we estimate sacrifice ratio. So for instance, if the initial inflation rate is actually high and also at an unanchored level, so in this case, sacrifice ratio will likely to be very high.
Can I ask you, sorry, what do you exactly mean by that inflation rate is unanchored?
I think what we're trying to say here is that in the environment where inflation rate is high and that the expectations of economic agents on the inflation level is unanchored, being that they are not too sure about what's really happening with inflation and that inflation is going haywire and they don't have much expectations of how inflation trajectory will be going on, then that's where sacrifice ratio would actually go pretty large. Yeah. Yeah. And from our findings, we'd also like to note that sacrifice ratio estimates.
Sorry, can I just ask a clarifying question? But this sacrifice ratio is just like the cost of the cost of
disinflation
of reducing inflation measured just in GDP, right?
Yeah.
But also, I mean, we don't have really a measure of the benefits because the other challenge, for example, especially in environments with high inflation, and when the inflation is on anchor, is that I mean that can also have like effects on GDP by itself, right? If you don't reduce the inflation or if you don't reduce at least the volatility of prices.
Yeah.
But with this measure, we are only looking at the cost. We don't really look at the benefit of reducing this inflation, right?
Yeah, we don't really actually cover that part, the benefits part.
Okay.
Just on the cost of this inflation.
Okay.
Yeah. I think that could be something that we could explore, but not in this exercise.
Okay.
Maybe
I mean,
like
because especially for policy making, it seems that the relevant it's not only taking account the cost, but also
The
the benefit, no?
Yep. Yep. Okay, so in this slide, just to wrap up this slide, what we did find is that sacrifice ratio estimates across different periods, countries, and even time frame would differ significantly. And these are attributed to the factors that we have listed here, including the initial conditions, such as the initial inflation rates, or rather the monetary policy regimes that was adopted at that time period. So for example, it could be a shift in monetary policy regimes to an inflation targeting regime, which might actually affect the size of your sacrifice ratio. So what we also did here, we actually also simulated a scenario that we had conducted during our study on how different environments will incur different magnitude of output losses to reduce inflation. So a linear environment here indicates that inflation environment remains benign and well anchored. And we have introduced two scenarios here for comparison. First is with our baseline core inflation scenario, and the second one is an elevated core inflation environment. And the policy framework here follows a conventional Taylor rule setting methodology. So as we can see at our baseline core inflation scenario, we estimated an output loss of around 1.5 percentage points, which requires a 50 basis points OPR hike to reduce inflation to 2.5%. And in the elevated core inflation environment, this will incur a much larger output loss at around 4% to lower inflation back to the same level, with an even larger magnitude of an interest rate hike. So in the high and persistent inflation conditions, what we did find is that sacrifice ratio will be nonlinear, and this is actually caused by a lower credibility of policy decisions from central banks and also a high and unanchored inflation environment. So actually the key takeaways from this scenario exercise is that monetary policy actions should always be preemptive before the inflation environment reaches an unanchored and also a nonlinear level. And besides that, we also find that it would be of the central bank's best interest to take monetary policy actions in an environment of benign expectations while establishing a high policy credibility to the public in order to minimize your sacrifice ratio.
Are there any data sets in Malaysia that go out and ask people, like, what are their expectations of price bundles for the future in some sense?
We do have a survey for that, which we call it the CSS. I think it's a consumer sentiment survey. And we also ask about their inflation expectations for like a future period, I think for specific years down the road or something. And also, besides that, we also look at their income groups, and we also splice them into like different areas across Malaysia because different parts have different like prices, expectations. So we do have that. And that is being supervised by our inflation team. So we do incorporate the analysis in our regular policy meetings.
So that would be interesting to now see, like, for all the explanations that you somehow kind of put up, to at least the stylized facts match it, right? If you said like has to do with this kind of unanchored inflation or much more uncertainty, the periods in which your models show you that your sacrifice ratio was much higher, and if you attribute it to these causes, when you look in the survey data, you should expect a positive correlation, right? You should expect these are the periods where people also stated, hey, I'm very unsure about where the prices of consumption bundles are going. And that would be kind of reassuring for a policymaker to see that these kind of sets of your explanations and the descriptive facts kind of line up in some sense. You know, that would be a valuable addition to your, when you're trying to unpack or interpret your findings in some sense.
I think that's something that we can definitely explore to see whether it actually coincides, which I think it would be, definitely. Thank you for that. So moving on to the conclusion. So in short, okay, what we found is that the annual sacrifice ratio for Malaysia is around 2.5. However, we would just like to highlight that the sacrifice ratio estimates does differ greatly on account of your choice of estimation methods, your potential output estimations, and also your sample size. And moreover, we also found that prompt policy actions from central bankers can lower the costs of disinflation. And this can be done by forming a well-anchored expectations with clear communication strategies from a credible central bank. So we've also noted some potential areas for future research work, and one of them is to look at a time-varying methodology for the econometrics approach to estimate sacrifice ratios. And this is actually due to the limitations of our existing approach, which assumes that sacrifice ratio is actually identical across the different disinflation periods, despite the changes that we did observe in the initial conditions. And that actually wraps up my presentation for today. And thank you for listening. And I think we'll open up the floor for any other questions and discussions.
Yeah, just a reminder, today we're gonna finish like 10:45.
Yeah.
So we have like 3 minutes for questions. Is there any question online?
Yeah, maybe let's ask.
I don't think there's question online.
So just to understand, because I could not really see what exactly is the econometrics approach, but what would you need to change in your identifying assumptions to allow for this time varying effects? You know, what ties our hands that you can't estimate time varying effects, because I don't know what exactly you're estimating, so I was just curious.
So maybe I can go back to the econometrics slide. So there's really actually two approaches here. First is the Phillips curve approach, and we look at the parameters that we estimated from the Phillips curve equations. And that is something that we fix for like over a long time series. So if we could develop like a framework that has time varying parameters, then that's something that we could explore to estimate sacrifice ratio using a time varying measure using the econometrics approach. As for the simulation one, I'm not too sure how we can do that, possibly also via a time varying parameters for the DSG model, because how we're doing it is actually by simulating an OPR height and to see what are the changes in your inflation and also output losses to estimate your sacrifice ratio. Yeah.
I just have one last question.
Yeah.
I mean, I'm a like general equilibrium guy, so I'm always looking for both sides. And for me, again, it's hard just to look at the cost, and because I don't know what the 2.5 actually means, because everything is relative also to the benefit. So I also would like to ask, like, for example, is there any way to compare this 2.5 with other countries, I mean, there is any reference for comparison or to have an idea of how low, how big is this number?
So we do have that actually in this slide. So we have listed out some of the sacrifice ratio for the United Kingdom, United States, and also Korea across different time frame that they had done. So maybe you can look at the second panel at the United States.
Yeah, I cannot see anything.
It's okay. Maybe you look at my screen.
Okay.
Like for the one for the United States, so they found that there was actually 4 disinflation periods. And if we would look at the recent one about 2007, 2010, their sacrifice ratio is only about 0.8.
And for example, the reduction in one percentage of inflation in Malaysia is equivalent to the reduction in these countries? Because, for example, if you do the same but for Argentina, like, I mean, reduction of 1 point inflation in Argentina is nothing, right? Because the rate is around 30%. So will in this case will be the same? Or we are looking at periods of like very high inflation?
For the 0.81, I think the initial inflation conditions are not too high because it's around 2.4 only for that time period. And I'm thinking back to how their targeting inflation rate is about 2%. I would say that this is not like a very serious case, unlike the Argentina case that you were mentioning. So whether it's comparable with our results, I think it's a little bit hard to say because we do have like a different framework. Like we're not specifically an inflation targeting a policymaker, so we can't really say that it's actually directly comparable. But what I suppose we can say is that it's not too large at 2.5. I think it's a rather kind of like expected results. It's really not too large, to be honest, because some of the other countries' sacrifice ratios could go as large as like 8, for example. It's not something that we have here, but that could also be caused by the specific disinflation period. It could be that inflation conditions at the time was like really, really bad and like really, really high. And also it goes like unanchored. That's why sacrifice ratio was so large. So overall, I think that 2.5 is about, I can't say that it's a good estimate, but rather it's something that's in line with our expectations in some ways. Yeah.
Well, so thank you very much. Thanks everyone for joining. Please fill the survey online and also here if you can scan the code. And see you next Tuesday at the same time, 11 a.m. Thank you very much.
Thank you.